Welcome back to the Daily Crypto Deep Dive. To understand what's happening in the market right now, and to make sense of why so many people feel confused, frustrated, or even disconnected from price action, we have to go back to the heights of the last cycle. Not because the past repeats perfectly, but because it explains how capital behaves when conditions change. And the single most common question hanging over today's market is simple but loaded. Where is all the money? At the peak of the last cycle, late 2021 and early 2022, crypto didn't just feel strong, it felt saturated with capital. Bitcoin reached its all-time high in November 2021 at just under $69,000. Ethereum peaked shortly after at around $4,800. The total cryptocurrency market capitalization briefly pushed above $3 trillion, with estimates at the time placing it between $3 trillion and $3.2 trillion depending on methodology. But what mattered even more than headline numbers was participation. Retail was everywhere. New users were onboarding daily. Exchanges were reporting record volumes. On-chain activity was elevated across almost every major network. Leverage was cheap and abundant. Funding rates were frequently positive. Risk appetite was extreme. Bitcoin dominance at that time sat closer to 40%. Ethereum dominance was higher than it is today. Altcoins collectively made up a far larger share of total market value. Capital wasn't concentrated. It was distributed, rotated, and constantly redeployed. Money didn't sit still. It moved. Stablecoins tell an important part of this story. At the start of 2021, the total stablecoin market cap sat around $25 to $30 billion. By the peak of the bull market in late 2021, stablecoins had exploded to roughly $180 billion. Tether alone had grown from around $20 billion in early 2020 to approximately $78 billion by late 2021. USDC was around $45 billion. Binance USD hovered near $15 billion. That growth tells us something crucial. Even during the mania, a large amount of capital was already choosing to park rather than speculate. But the difference then was velocity. Stablecoins didn't stay parked for long. They moved quickly from cash to risk and back again. They were transactional. Now fast forward into 2022, and the environment changes violently. Bitcoin opened 2022 trading at roughly $47,700. Ethereum opened the year near $3,700. The total market cap was still comfortably above $2 trillion. On paper, things looked healthy, but underneath the surface, the system was already under strain. Inflation was accelerating. Central banks began signaling rate hikes. Liquidity conditions tightened. Leverage became more expensive. Risk assets across traditional markets started to wobble. And crypto, which had benefited massively from ultra-loose monetary policy, began to feel the pressure. Then came the collapse that permanently altered the landscape. Terra and UST. The Terra ecosystem, built around the algorithmic stablecoin UST, imploded in May 2022. At its peak, UST had a market cap of around $18 billion. Luna, the token that was meant to stabilize it, carried a market cap north of $30 billion at its height. Within days, both effectively went to zero. Roughly $40 billion in value vanished. This is where one of the biggest misconceptions about where the money went needs to be corrected. That money didn't rotate into Bitcoin. It didn't move into stablecoins. It didn't sit on the sidelines. It was destroyed. Completely. And Terra was not an isolated event. It exposed leverage, counterparty risk, and fragile structures across the ecosystem. Three Arrows Capital collapsed shortly after. Celsius froze withdrawals. Voyager failed. Eventually, FTX imploded in late 2022, wiping out additional tens of billions in perceived value and trust. Each failure didn't just scare capital away, it removed it from the system. By the end of 2022, Bitcoin was trading around $16,500. Ethereum hovered near $1,200. The total crypto market cap had fallen below $800 billion at its lowest point. Participation had collapsed. Retail interest had evaporated. Search trends were near cycle lows. On-chain volumes dropped sharply. This was the reset. Now, fast forward again to today, and this is where confusion sets in. Bitcoin today trades in the mid to high $80,000 range, depending on the session. That puts it well above its 2021 peak in absolute price terms. The total crypto market cap is again approaching $3 trillion, sitting just under that figure at around 2.9 to 3 trillion depending on intraday moves. On the surface, it looks like the money is back, but it doesn't feel like it. Volumes are lower than during peak mania. Retail participation remains muted. Altcoins are nowhere near their prior highs. Ethereum is still well below its all-time high despite Bitcoin setting new records. So what gives? The answer is concentration and behavior. Let's start with Bitcoin dominance. During the 2021 mania, Bitcoin dominance fell toward 40% as capital sprayed into altcoins. Today, Bitcoin dominance sits closer to 57%. That tells us that a much larger share of total market value is now concentrated in a single asset. That alone explains a lot. You can have a similar total market cap with far fewer assets contributing meaningfully to it. Bitcoin's rise can mask weakness elsewhere. Ethereum tells a similar story. In 2021, Ethereum's market cap peaked around $560 billion. Today, despite massive ecosystem growth and ETF speculation, Ethereum's market cap is still significantly lower than that peak in real terms. Participation hasn't fully returned. Now look at stablecoins again, because this is one of the clearest trails of where money actually is. Today, the total stablecoin market cap sits north of $300 billion. Tether alone is around $186 billion, significantly higher than its peak in 2021. This is important. Stablecoin market cap today is materially higher than it was during the last cycle peak. That means more capital is sitting in crypto's internal cash system now than when prices were euphoric. That money exists, it hasn't vanished, but it's not moving. Why? Because behavior has changed. Capital today is defensive. It is cautious. It is yield-aware. Outside of crypto, money market funds now hold over $7.5 trillion. That option did not meaningfully exist during the previous cycle. Back then, holding cash meant losing purchasing power. Today, holding cash earns yield. This fundamentally alters incentives. Inside crypto, capital has also found new rails. Spot Bitcoin ETFs now hold over 1.3 million Bitcoin. That represents more than 6% of total supply. At current prices, that's well over $100 billion in exposure. That Bitcoin is not being traded daily. It's being held in regulated structures by institutions, pensions, and long-term allocators. It doesn't chase altcoins. It doesn't rotate quickly. It supports price, but it doesn't create velocity. This is why Bitcoin can grind higher while the rest of the market feels lifeless. Altcoins, on the other hand, are suffering from a lack of speculative capital. In 2021, altcoins thrived because capital was abundant and impatient. Narratives alone could move price. Today, narratives need liquidity behind them, and that liquidity hasn't returned. This leads to one of the most misunderstood dynamics in crypto markets. Altcoins don't collapse because people panic. They collapse because people stop caring. Indifference is more damaging than fear. Now let's talk about why we keep seeing these short bounces followed by quick drops. In a market dominated by cautious capital, rallies are often driven by positioning rather than conviction. A bounce can occur because shorts cover, because funding resets, or because macro news temporarily improves sentiment. But without sustained inflows, those moves struggle to hold. Capital takes profit quickly, risk is reduced quickly, and price falls back into range. This is why the market feels stuck. It's not broken. It's waiting. The triangle structures, the compression, the repeated tests of support and resistance. All of this reflects indecision, not collapse. Buyers are present, but selective. Sellers are present, but not aggressive. Liquidity builds. And this brings us back to the core question. Where is all the money? Some of it was destroyed in 2022 and has gone for good. Some of it sits in stablecoins, waiting. Some of it has moved into yield outside crypto. Some of it has concentrated into Bitcoin via ETFs and long-term holdings. And some of it simply hasn't found a reason to return yet. Markets don't reward hope. They reward confidence. and confidence doesn't return until conditions feel stable, not just prices. This phase feels uncomfortable because it's designed to be. It strips away excess. It tests patience. It forces participants to think in terms of time horizons rather than quick wins. When the next phase begins, it won't look like the last one. It will start quietly, with small increases in participation, with volume returning slowly, with capital testing the waters rather than diving in. And when that happens, the question won't be where did the money go? It will be how long was it here before people noticed? That's where we will leave it for today. Keep the faith, remember what brought you here, and as always, we will see you at the top.